In the previous videos, I explained the rules of the one moving average strategy. In this video, there is no theory, no motivation, no hype. We are going to go straight to the charts. I will show you real examples, winning trades, losing trades, clean setups, and trades you must avoid. The rules are going to be the same EMA 240, same default MACD. If this strategy works, it must work on all live charts, not on PowerPoint slides. I hope you remember our setup. Go to indicator, trend, nope, indicators, insert indicators, trend, moving average. And we're going to be having our moving average parameters to be period 240, exponential moving average, that is the method, and we are going to be applying it to the close as we have here. So on the chart we have our exponential moving average 240, and then we are going to be inserting our MACD. MACD is an oscillator and it's going to be the default MACD. If your settings are mixed up, you just go to reset and it is going to take you to the default MACD. So we're going to say OK here, and that is it, and this is it. So we have our setup clean. So this is a quick reminder. EMA 240, is the moving average we are using. The MACD we are using is the default MACD. Our entries remain the same. The risk remain the same. So we are going to go quickly into showing us what happened in recent times in the market. If you skip the rules, pause this now and go back. This video assumes you already understand the system. So we are going to be going over everything briefly. Now, these are the rules. Number one, we said that the EMA 240 gives us the direction of the market. So we wait for the market to be above the EMA 240, and that places us in a position to be buyers. As we have here, we have 1, 2, 3, 4 candlesticks that are completely above the EMA 240. No tail touching EMA 240. That is rule number one. because the moving average gives us the direction of the market. And then once we have that, we wait for a pullback to the moving average. And we said that our pullback is determined using MACD. And this is how we use the MACD to determine the pullback. When we have the histogram bar goes below the signal line, that is the red line. So in this case of Euro USD, the signal bar, the retracement bar, the pullback bar is this. That is this candlestick, determined by the histogram bar that closes below the MACD signal line. So once we have this, our pullback is complete. We are not going to be making use of the candlesticks to determine our pullback. So please get that very, very clear. The pullback is determined by the MACD histogram going below the signal line of the MACD in an uptrend. So now the next thing is that we wait for the first histogram bar to close above the moving average, which is, yes, above the signal line, sorry, which we never got here. So we see that the histogram bars are forming below the MACD signal line. The signal line is the red line. In case you do not know how MACD is used before, you can revert back to our previous videos. So we see that the here none crossed above again till they cross the watermark line. That is the 0.00 level line. And then the MACD now nullifies the uptrend determined by the EMA 240. So we now begin to wait for another setup. Here we see that the price came down and hit the 240 EMA, that is moving average, and then the market bounced back and continue to move upward. So the market continued to move upward. So at this point, dropping down to the MACD, we see that the signal line of the MACD and the histogram bars both were now below the 0.00 level. So we wait for them to cross over again to the upside, and here they did. So everything is up again, and at this point we are comfortably above the 240 moving average, exponential moving average. So now we wait for pullback, and then we got the pullback here. We got the pullback at this histogram bar after this horizontal line. So once we have this is the candlestick that corresponds to it, we are okay. We begin to look for a candlestick that closes above the red line, that is the MACD signal line, and we got it here. So at this point, this histogram bar in front of, let me remove this one, in front of this horizontal, this vertical line is the signal line. So this gives us the signal, and we look at the corresponding candlestick and then place our buy at 3 to 5 pips above the high of the candlestick that corresponds to the first histogram bar that closes above the signal line, that is the red line of the MACD. So now this is it. Now here we see that price is comfortably above the EMA 240, that exponential moving average 240, And then we go to MACD to get our entry, and we see that before this time there was a pullback, and that is the MACD histogram bars forming below the MACD signal line, and then this particular signal line histogram bar became the first histogram bar to close above the signal line. After we had a drop, we had pullback. So, and then it's simple. It's that simple. That's all. You press your trigger here and then you watch. So that is how to get our entry. This is very, very simple. This is not genius trading. It requires discipline for you to be where you are supposed to be. So this is how to buy. And then how do I come out of the market? When do I come out of the market? Let us keep going. You're going to come out of the market because we are trading momentum. And once there is no momentum, we want to exit the market. So we are not trading trend now. There is difference between trading trend and momentum. In a trending market, there may not be momentum and the market will still be trending. And there may be momentum. So, but this particular strategy is for trading momentum. So once momentum ceases, we want to see how to come out of the market and wait for the next momentum move. So here now, the first candlestick that closed below, or that forms below the signal line, gives us an indication that the momentum may be weakening. So it takes us to a place of uncertainty in trading, and you may consider exiting at this point. The first one, we call it good, and the second one, we call it better. The third one, we call it best. You can even go further to wait for a confirmation of the best. That is to confirm that actually I don't want to be inside this trade, by allowing a close below the three candlesticks that gives us opportunity to exit the market quickly. But this is just by the way. So you can now, when you go for good, you exit. You are going to exit here. So the candlestick that corresponds to the good exit, you just place 3 to 5 pips below the candlestick. You would have exited. Would you have exited? Well, you still have been in the market, though you would have exited later. But if you want to go for the best, that means you have to wait for three histogram bars to close below the signal line, and these 3 histogram bars must be consecutive. Once we have good exit, that is the first histogram bar that closes below the signal line, and then you have the next one closing above the signal line, so it nullifies the good exit. So remember this very well, that we have the good exit, the better exit, and the best exit, because we want to maximize profit. We want to protect our account. So once there is no momentum, we want to get out of the market, and then we wait for the next momentum move. So let us keep going and see. Let's keep going. Let's go bar by bar now. So at this point, we see that we are supposed to exit at this point, but we see that subtracting 3 to 5 pips here will still keep us in the market. So meaning that with best exit, we are still in the market, even with better exit. In this case, we are still in the market, and the market keeps dropping. Sorry, the histogram bars keep forming below the signal line. We are still in the market, and this is the next opportunity. This histogram bar after pullback. Please do not forget our definition of pullback. It is not the conventional definition of pullback that you know, where the candlestick's formation determines your pullback. Here, the MACD histogram bars determines your pullback. Once in an uptrend, once they begin to form below the signal line, the MACD signal line, that is pullback. And then here we have the first MACD histogram bar that closes above the signal line. And then we just go to the corresponding candlestick and buy the high of that candlestick by adding 3 to 5 pips. So that is that now, and this is where the market is currently in Euro USD. Today is 28th of January 2026. So you have had a good run. You've made some good money trading this system in this particular time. And if we drop to, okay, let me save this chart. Lest I forget, once you enter the first trade or your trade, your initial stop loss, do not come and put it at just below the most recent stop loss. Go below the EMA 240, the first swing low below it, somewhere here, and then you put your stop loss, your initial protective stop. Rather, that is going to determine the number of trades you are going to place. And do not forget that if we are placing 10 trades, we make sure that in case we lose all the 10 trades, we are not going to lose more than 1% of our balance or our equity, whichever one you choose. We are not going to lose more than 1%. If we are going to have 100 trades running, we are not going to lose more than 1%. So when you reverse everything for sale, you're going to get the same result. Then let us check out gold, because this technique can be used to trade. Let me save this. Save template as EMA 240. We save it. Let us go to gold and see what happens. So if we insert our technique on gold, EMA 240, let me just reduce the chart, and then you just see the performance of this awesome technique. Very awesome. And then it enables you to grab something from the market. It allows you entry into the market when you should enter. You are trading momentum, so you grab the momentum, and once the momentum is reducing, you come out of the market. Remember, we are trading momentum and not trend. We want to leverage on the momentum of the market and then come out quickly. So at points like this, where the market came to touch the EMA 240, do not rush into the market when EMA 240 is rejecting pullback from the market. Wait for our setup. We are not trading rejection here. There are techniques to do that. We are not in process of time, we will be there. But for now, we want to take traders, especially traders that are losing consistently. We want to take out of those 90 to 95% consistent losing traders. We want to take them and make them winning traders, God helping us. So from observation, you can see what this technique did on gold. Let me enlarge it now and just work on it briefly. So at this point, because we want to start from simple to tough, we start from simplicity to complexity. So at this point, the market crossed over and formed 4 candlesticks that are above the EMA 240. So we wait for a pullback, and we got the pullback here, but the pullback didn't go well. It dropped below the 0.00 level. So we begin to wait for another setup. At this point, 1, 2, 3, 4, we had 4 candlesticks that formed completely below the EMA 240. So we would have changed our mind here to be going down, but then the market turned up again, formed 4 candlesticks above the EMA 240, and then here we had a pullback, and I think at this point the market closed above the signal line. So we would have bought here, but then we would have exited the market somewhere here. So nothing here, no loss, no profit. We exit the market, and then the market continued to pull back here. So you see, at this point, the MACD is giving us a pullback, but the candlesticks are still forming. They are going up. They are forming higher highs. So we consider that a pullback. So at this point, we had opportunity to buy again. So we buy the high of this candlestick. Remember, this is gold. And once you buy this high, our initial protective stop, we want it to be below the EMA 240 and the swing low below it. And the first swing low, the nearest swing low to the EMA 240 is this point. That is the low of this candlestick. This is the lowest point below the EMA 240. So we buy here, and then let us see how this played out. And we're going to watch when momentum is going to decrease. Yes, momentum dipped here. So when we have 1, 2, 3, we want to exit the market somewhere here, and then let's see how it played out. The market took us out. So here we suffer a little loss. We're going to accept it like that. When you suffering a little loss, is not bad trading. It's not bad trading. It simply means the market did what it wants to do, and then we're taking out. It simply means that the market structure failed, and then the stop loss was respected. Losses are not a mistake. Refusing to accept them is the mistake. Refusing to accept losses is the mistake. So we accept the loss there, and then we keep waiting for another opportunity. Let me tell you how professionals view losses. It is different from how losing traders view losses. Professional traders consider losses as payment for knowledge they are supposed to acquire. It is not a mistake. It is the pattern, the structure, market structure failing. So you accept it and wait for the next move. Here, the market dropped below, the MACD dropped below the 0.00 level. Yet, the candlesticks are forming above the EMA 240. So you keep watching. So the EMA 240 is still telling us that the market is uptrend. Here we have a candlestick that touched it, and then in no time 4 candlesticks form above it again, telling us that we're still going up. We are still buyers. So wait for MACD to confirm it. So this is how it goes. So you just need to be patient with the market, and then do what you are supposed to do. Basically helps you to be in tune with the market, and then it helps you to enjoy your trade. So at this point, we have opportunity to re-enter the market. We are not going to waste that. We buy here, and that is it. A very clean setup, and you go. So this technique is applicable to all. It's applicable to all markets, whether it is Forex or it is metals, indices, and what have you. If I'm going to check quickly for downtrends, we are still going to enjoy the same move. At this point, we have 1, 2, 3, 4 candlesticks formed below the EMA 240, and then that is at this point. Yes, at this point there was pullback, and then the market came out here. What are you going to do here? We are not going to sell here. We are not going to sell here based on our methodology, because there was a crossover here. So this is the market is going to come here, descend gradually first, have pullback, and then this is where you enter. You exit. There are other opportunities later for you to sell, and you make your money. So this technique keeps you out of the choppy markets, and then helps you to maximize the market that are moving, that have momentum. That is the beauty of this technique. It's just so awesome. Apply it on gold, you enjoy your trading. So patience is going to help you to be at the best of the game. This is Oracle's Trading. If you are not subscribed to Oracle's Trading, subscribe now and turn on the notification. Do not forget to turn on the notification, so that anytime we upload new videos, you can be notified. Make comments. Any questions you have, comment on the platform, like the videos, and share the videos.